Hey y'all, it's John. I recently bought the Sun because these financial gains are way too hot. So I'm hoping to see you up here. And today we're going to go over how to beat the stock market with low risk selling covered calls. So let's get to some knowledge. Now, I'm sure you heard it before. Beating the stock market is almost impossible. Options are risky. You're never going to do it. Warren Buffett can't do it. Blah, blah, blah. It's a bunch of crap. So I'm going to go over how to do it simply, just selling covered calls. I'm going to go over a couple details on this strategy and how I'm doing it this year. And in this strategy, we're not looking for stocks. We're not doing anything fancy. If we're going to try to beat the stock market, we might as well just use the stock market and gain a little extra income. So what do I mean? On my computer, I have SPLG. It's basically S&P 500, but smaller. And you can see I have about 10 grand in this. So I've been buying every day. I've been buying about $75. So my cost basis is higher than it was at the end of the year. But in this video, we're going to use a hypothetical portfolio, just saying if I just bought 100 shares on January 3rd, the first trading day of the year. So let me go over to this tab. The first day, I would have bought 100 shares at $44.78. Now, I am buying 100 shares because in order to sell covered calls, I need 100 shares for one contract. So keep that in mind if you're not completely familiar with selling calls and selling puts. In order to sell a contract, you need 100 shares. So I'm going to buy 100 shares on day one at $44.78. So my first cost is $4,478. Now, we can see at this year, it's at $48.33 right now. It's a 7.93% gain on the year as of the recording date of 5/9/2023. So, in this hypothetical portfolio, I'll be buying 100 shares on the first trading day of the year. How are we going to beat the stock market? We're going to beat the stock market by selling covered calls at opportune times throughout the year. So I pulled up SPLG. It really tracks basically the same to S&P 500, guys, to SPY. A little bit different variation, but it's really about the same. So when am I going to try to sell covered calls on SPLG? You can see the MACD indicator has been tracking this fairly well recently. You can say we had a crossover down in November. We had the spike up, but then it fell back down. We can see we come to February. You can see when it crossed over down, it was a similar down movement. And now we're kind of replaying the same thing. We had a crossover down on Tuesday, April 25th. It went a little bit higher, then it crossed back down. What we're doing at these crossing points is when it crosses down, supposedly it's losing momentum according to our indicators. That's where we're going to sell a covered call just to collect a little bit more premium to beat the stock market. The chance of us getting called away at that point is a lot lower than if we're doing, let's say it just crossed over. We're going to sell a covered call here. We're going to get called away and lose our shares, and then we have to buy them back at a higher price, right? So you're going to lose there. You can do it again with the momentum. You're going to lose there. So we're just being conservative, just trying to collect some more money to beat the S&P 500 by a couple percentage points. And I have proof I'm doing this. As I said, if I go to my Robinhood, my average cost is higher because I didn't buy 100 shares on the first. I've just been buying every day because I expect the stock market just kind of chop sideways for a bit. So now's a good opportune time, or maybe it'll dip lower. No one really knows, but all I know is I'm just going to keep buying SPLG so I can continue with the strategy, because then you don't need like $40,000 to do with SPY. But here's my proof of work. Let me pull up my screenshots. Now I'm using screenshots because I really had to dig in Robinhood. So these are just screenshots from all the trades, and I've only done 2 covered calls this year so far on SPLG. So you can see on 2/17, I sold a $50 SPLG call for $25 a share. So I collected $25 in premium. Keep that in mind. And then you can see on February 10th, up at the top of my screen, I bought it back at $5. So 25 minus 5 is $20. So far I made an extra $20 on my hypothetical portfolio of $4,478. That was the 100 shares I bought on the first trading day of the year when the stock was at $44.78. So as of now, I'm up $20.
Let's go.
But I also did it in April. I sold a covered call on 4/21 at a minimum of 20 cents. So that's $20 because time 100, and I collected $20. And then this one expired worthless. So I collect So I collected all of the $20. So I collected $20 in February, and I collected $20 in April. So I collected $40 extra off of my $4,478 investment at the first day of the year.
Let's go.
So let's go to Google. So the return for this year at the time recording this video is up $3.55. So times it 100, that's $355. If I bought 100 shares at $44.78 on January 3rd. But now we need to add $40 because we collected 44 extra dollars. So let's go to 355 plus 40. So now we actually made a $395 profit, not including dividends so far. So now let's figure out our actual percentage of how much we made. So we have to divide that by our cost basis, $4,478. Remember, $44.78 times 100 shares because we're selling contracts. So we need 100 shares. As long as times that by 100. So we have a 8.8% gain on the year selling 2 covered calls. So as of now, in my hypothetical portfolio, if I just bought 100 shares at the beginning of the year, I would almost be beating the stock market by 1%. This isn't including the taxes, right? I'd have to pay some taxes on this. But if I could do this one more time, I would be beating the stock market by almost 1% or 2% if there's a couple more opportunities like this year. We're going to be conservative, right? I'm just doing this when the MACD crosses over. I'm not just trying to sell them monthly if the opportunity is not right, and then I'm just getting called away because I'm not going to win. But it's very easy if we have a sound strategy in mind. We can use the S&P 500 and then beat the S&P 500, collecting a little extra cash, selling covered calls. So it's not actually that difficult to beat the stock market. You do run the risk of getting all your shares assigned away, but you can buy out and then take the L for the year. And by take the L, maybe you lose a few $100s and you get to keep all your shares if you really want to. I think this is sound strategy to beat the S&P 500 year over year because you don't really want to sell those shares, buy them back, and then have a taxable event if you haven't been holding them for a year, because then that's going to be a lot of money given to the tax man, to Uncle Sam. So there you have it, guys. Proof that it's not hard to beat the S&P 500. Proof that I'd be hypothetically doing it if I bought 100 shares on the first day. But as I said, I'm DCAing in right now because I think we're going to be in a chop or a slightly downward market. I don't really know what's going to happen. All I know is I'm just buying every single day with the cash that I have. So if you want to start wheeling ETFs, check out this video here and let me know where you want to see me next. I already bought the sun. Maybe the moon is next. I'm not sure. Peace.